Hey, hi everyone. Welcome to today's webinar. Excuse me. Um, Today we will be talking about the VIX Index and how it can tell us a bit about the markets. Before we get started, we'll give about 2 more minutes to let more people join our session. So in the meantime, let me know in the chat if you guys can see me and hear me. You can see my slides as well. And yeah, we'll begin in about 2 more minutes. Thanks, everyone. Okay, let's go ahead and get started. So again, for those of you guys who've just joined, today we will be talking about the VIX Index, and how it can tell us a bit about the sentiment, the market sentiment. Before we get started, we'll go through the risk and disclaimer as per usual. So a risk warning, our products are traded on margin and carry a high level of risk, and it is possible to lose all your capital. These products may not be suitable for everyone, and you should ensure that you understand the risk involved. Disclaimer: the information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. This material is just the personal opinion of the author, and the client's investment objectives and risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained herein, and redistribution of the material is strictly prohibited. So I'm Melanie, and I'll be your tutor for today. I'm an investment analyst at Rocket, who finalist for Best FX and Equity Research in the years 2019 to 2021. So here's our agenda. We have quite a long list of things to get through today. We're gonna go through an intro on what exactly it is, and what it measures. Then we'll look at how VIX reflects market fear and overall volatility. And then we'll use it to forecast major market movements. Examples include corrections and rallies. And then we'll look at some trading strategies, how to hedge against volatility, and some real-world examples of market reactions to VIX spikes. As a bonus, if we have time, we will also go through how the US election might impact the financial markets, since that is ongoing currently. And we'll go through some economic indicators and some risk management to take note of during election volatility. So we'll be going through a lot of volatility management strategies today. So let's go ahead and get started. Feel free to let me know in the chat if you guys have any questions throughout the webinar. And yeah, let's go ahead and get started. So just as a introduction to the VIX Index, it was created by the Chicago Board Options Exchange, or the CBOE, and it measures the expected volatility in the S&P 500 over the following 30 days. So it's known as the fear gauge, and it's calculated based on the prices of options on the S&P 500 index, giving a sense of market expectations for short-term volatility. So the definition of the VIX index and the calculation over here, the second bullet point, is from the official CBOE website. So it's a calculation designed to produce a measure of constant 30-day expected volatility of the US stock market derived from real-time mid-quote prices of the S&P 500 index, or SSPX, call and put options. On a global basis, it is one of the most recognized measures of volatility widely reported by financial media, and closely followed by a variety of market participants as a daily market indicator. So when VIX values are high, it suggests that investors expect turbulent times, whereas a low VIX indicates that markets are calm. The VIX is unique in that it captures implied volatility, which is based on how much market participants think the S&P 500 might fluctuate, rather than just looking at historical volatility. Okay, so the VIX is highly sensitive to shifts in market sentiment, and here's how it works as a barometer for fear. So a high VIX, which ranges above 20 to 25, this level suggests increased market fear or uncertainty. Investors may be concerned about events such as economic instability, geopolitical tensions, or upcoming announcements from the Federal Reserve. A very high VIX, such as 40 or 50, often signals market panic, as seen in major crises like the 2008 financial crisis or the COVID-19 pandemic. A low VIX, which is below 15, signals a calm market where investors are generally confident about stability. While it might indicate complacency, it also reflects lower expected price swings, meaning that investors are less fearful of sudden market shifts. So understanding these ranges can help you as a trader gauge market sentiment and make decisions about your risk management strategies. Okay, so now let's look at how to use VIX as a predictive tool. So firstly, you can use it to identify corrections. So a sharp increase in the VIX often accompanies corrections or bear markets, as fear drives investors to buy protective options. So spikes in the VIX can serve as warning signals of potential downturns, allowing traders to anticipate and prepare for corrections. Number two is spotting market bottoms. So during a market sell-off, the VIX may reach extreme highs. So this can signal capitulation, which is basically when investors sell en masse out of fear. So a very high VIX can sometimes signal the peak of market fear, after which a reversal may occur. And number three, anticipating rallies. So after prolonged periods of high VIX, market stability can improve, potentially leading to a rally. So a declining VIX during a downturn can indicate that fear is easing and markets are poised for a recovery. So let's just quickly go ahead and look at CBOE. website. Okay, um, this is the most current data from our VIX. Okay, yeah, this is just the cboe.com website. Okay, let's get back to my slides. Okay, so next, let's talk a bit about VIX-based trading strategies. Um, Firstly, we have the options and futures. So traders can buy VIX options or futures contracts to gain exposure to volatility. So for example, if you expect a market drop, you might buy VIX call options, which gain value when the VIX rises. Second is the ETFs and ETNs. So ETFs are exchange traded funds and ETNs are exchange traded notes. And these are tied to the VIX, which offer exposure to volatility without directly trading futures. So an example includes the VXX, short-term VIX ETN, and the UVXY, which is the leveraged VIX ETF. So these instruments can be used for shorter term hedging or for speculative purposes as well. Okay, so number three, hedging with the VIX. So if you have a portfolio of stocks, a rise in the VIX often correlates with declining stock prices. By adding VIX exposure through either the ETFs or options, you can offset some of the potential losses in your equity positions during volatile periods. Number four, mean reversion trades. So the VIX is known to revert to its long-term average over time. After extreme spikes, some traders use mean reversion strategies, anticipating that the VIX will return to normal levels once fear subsides. Okay, so now let's take a look at some real-world examples of how markets reacted to VIX spikes. Number one is the 2008 financial crisis. So the VIX surged above 80 during the height of the 2008 crisis, reflecting extreme fear. This spike coincided with one of the steepest drops in the S&P 500. As the VIX eventually declined, it signaled a calming of market fears, allowing for recovery. Next, we have the COVID-19 pandemic in March 2020. The VIX again reached levels above 80 as the pandemic began, signaling intense fear and uncertainty. The market saw a swift downturn, but as the VIX fell in the following months, it corresponded with a market rebound. And number three, other events such as your elections, major Fed policy announcements, and geopolitical events like Brexit or trade wars also led to notable VIX increases. Each spike served as a signal that the market expected increased risk, often preceding market volatility. Okay, so some key considerations when trading the VIX. Firstly, some factors to keep in mind, the VIX decay and mean reversion. So VIX-based instruments like ETFs can experience decay due to their reliance on futures contracts, which roll over each month. So this means they're often better suited for short-term trades than long-term investments. Next is event-driven spikes. So specific events such as your elections or Fed announcements can cause temporary VIX spikes, which often return to normal levels once the event passes. And lastly, alternative volatility indicators. So some traders can also consider other indicators like the VVIX, which is the volatility of VIX, or the MOVE index, volatility in the bond market, to get a broader view of market sentiment. Okay, now let's go ahead and take a look at the US elections and take um yeah, let's take a look at the US elections and take a look at how it might impact the market. Okay, so between Trump and Kamala, there are different White House strategies which will favor different stocks in 2025. So there are three main themes surrounding each candidate's potential success in today's election. Um, we have energy, financial, and industrial. So, in terms of the energy trade, the Biden administration believes in taking serious action to fight climate change. A Democratic victory would provide a mandate for continued federal investments in renewables, in particular via subsidies or tax breaks for firms like Enphase Inc. On the other hand, a Republican victory would likely eliminate the renewable investments and tax breaks by shifting federal support to fossil fuels. And lastly, there has been strong support for faster permits, looser environmental regulations, and extension of tax benefits for oil and gas firms such as ExxonMobil. And on the financial side of things, from a Republican standpoint, President Trump has a proven track record of cutting financial industry regulation, and it's likely that this will continue if he wins. Most notably, the Trump administration worked to roll back fair housing rules under the Department of Housing and Urban Development and helped Congress pass comprehensive regulatory relief legislation in 2018 that targeted reforms of the Dodd-Frank Act. The bottom line would likely improve for banks and support for broad funds like the Financial Select Sector SPDR fund as a result. And Bitcoin is also likely to benefit from a Republican win. On the Democratic side of things, for Vice President Harris, she has targeted big banks to help residents impacted by foreclosures and win a $20 billion relief package while serving previously as California's Attorney General. Additionally, she cracked down on student loan lenders to limit what she saw as predatory lending practices. It hints that Wall Street may have a much less receptive administration in the White House, as the prospect of more regulation may stifle the sector. Now, lastly, the industrial trade from a Republican standpoint. President Trump has been very vocal in his attacks on foreign competition, especially China, going as far as floating the idea of a 10% across the board tariff on all US imports. Tariffs could place a tremendous burden on MNCs with overseas customers and international supply chains such as Apple. On the flip side, domestic SMEs are likely to benefit from such trade barriers and Made in the USA policies. From the Democratic side of things, in general, Democratic policies favor electric vehicles and alternative energy over other technologies, as we've already mentioned in the energy section in terms of their renewable energies. So the Biden administration has focused on high-tech manufacturing and supply chains via the 2022 CHIPS and Science Act to support the semiconductor industry over manufacturing of more traditional goods and machinery. Companies such as Micron and Intel would be primary beneficiaries. Let's look at the key news and economic indicators to watch out for during election trading, especially during periods of very high volatility. So here's what to keep an eye on. Firstly, we have polling data and major polling updates. News outlets often will release updates on polling. These, um, you can take a look at any major news outlet. So these can cause short-term market reactions. So you can watch polling trends, particularly in the swing states, as they can give an early indication of the election's direction. Economic policy announcements, statements about future economic policies from the candidates or parties can cause price fluctuations, especially in sectors like we've mentioned earlier, energy, finance, and industrial, but also especially healthcare. Can look for any indication of changes in tax, trade, or fiscal policies that could affect these industries. Number three, Federal Reserve statements. So while the Fed remains politically neutral, its monetary policy responses to election outcomes can influence markets. So you can listen closely to Fed commentary on inflation, interest rates, as the outcome of the election may shape its policy direction. Number four, international relations updates. So geopolitical relations often come under scrutiny during elections. So you can look for news on trade agreements, foreign policy changes, or diplomatic relations with major countries, especially China and the EU, because these can impact the dollar and commodities like gold. And lastly, market sentiment indicators. So tools like the VIX that we just went through give us a sense of the market sentiment and perceived risk. So a rising VIX will signal increased anxiety among investors, while a lower VIX might indicate optimism or stability. Okay, so pre-election versus post-election effects on markets. So pre-election, the lead up to the election often brings speculation-driven price movements. So we typically see more price swings as investors react to polling data, debates, and other election-related news. Volatility in this period is usually driven by sentiment rather than fundamentals. Now, post-election, following the election, markets generally begin to settle as new policies are enacted, providing a clearer picture. However, if the result is contested or unclear, this uncertainty can prolong the volatility. Okay, so let's take a look at how you can manage risk and money management during election trading. So volatility can present both opportunities and risk, as we've seen. So having a plan for managing these, especially during the election period, is essential. So firstly is to set tight stop losses. So during high volatility periods, price movements can be sudden and large. So using tight stop losses helps to protect from unexpected price swings, keeping your losses within manageable limits. Key number two is adjust position sizing. So you can consider reducing your position size because trading smaller positions minimizes your exposure and helps to manage risk in case of a large rapid movement. So you might choose to trade a fraction of your usual position size during the days surrounding the election. Next, use hedging strategies. So we'll go through a couple of hedging strategies in a bit, but hedging can help to counterbalance the risk in one position or with another. Let me adjust my camera. Okay, so So for example, if you're trading equities and you're worried about a sudden market drop, you might open a small short position in a correlated asset, um, or you can use options as a protective hedge. Like some of the examples that we gave earlier with regard to VIX. And next, number 4, limit leverage positions. So high leverage can be risky in volatile markets, as price swings could lead to greater than expected losses. So you can consider trading with minimal or no leverage, especially during this high risk period. And lastly, is having a cash reserve. So it can be beneficial to keep part of your capital in cash to take advantage of opportunities that is after election related volatility has settled. Okay, so let's talk a little bit about technically or technical analysis wise how you can manage risk and manage your trade. So in order to figure out how to manage a trade, it's first important to understand what a trade consists of. Okay, so you have the basics, which are the entry, stop loss orders, take profit orders, and then you have the break even, partial profit strategies, the idea validation, and trading stop loss strategies. And of course, diversification is important as well, so that it spreads out your investments across different assets, markets, and sectors to reduce your overall risk. Okay, so let's take a look at this example. We're gonna go through first the problem with a fixed take profit. So the red area shows us a strong resistance area since there have been two swing highs in line with that area. So if our trading strategy requires us to have a fixed take profit of 100 pips, we would place the target beyond the strong resistance area. So let's see how this plays out. So price shot up, missed our profit target by a few pips before reversing back down to our entry. Now, in an alternative scenario, if we had placed our take profit before the key resistance level, we would have gotten a profitable trade. So that's why it's important to look at the charts and adjust your take profit or stop loss accordingly. Okay, next, let's look at trade management with Fibonacci confluence. So here's the proper stop loss and take profit placement. Here we're talking about Fibonacci confluence, but this works for any resistance or support levels. So for starting off with stop loss, we would always place it beyond a key level or key area. The reason for this is because more often than not, price is attracted to such strong areas of Fibonacci confluence or resistance, and excuse me. And if your stop loss is right before instead of beyond it, you will most likely get stopped out before the market reverses. And that's also one of the reasons why people wonder why they got stopped out right when the market starts to reverse, and then they start complaining about stop hunting. Okay, next is take profit, and you should always place your take profit before a key Fibonacci confluence area. Reason for this is because when price reaches your confluence area or resistance area, there's a high chance that it won't be able to go beyond it. And instead of reaching your profit target, it reverses back to your entry, or even worse, your stop loss. So that's also one of the reasons why people complain that the market is being manipulated because they missed their take profit by 1 pip. Okay. So next we have the proper stop loss take profit placement. This is an example of a sell entry. So here we would place our take profit and stop loss above the major resistance areas. Whereas here you can see in the example, we're going for a buy entry, so we place our stop loss and take profit below both of the confluence areas. Okay, any questions so far? Any questions? No? Okay, great. Okay, now let's look at another risk management strategy, which is our trailing stop loss. So a trailing stop is a special type of trade order that moves relative to price fluctuations. So when the price goes up, it drags the trailing stop along with it, but when the price stops going up, the stop loss price remains at the level that it was dragged to. So automatic trailing stop loss moves accordingly as price moves favorably. Manual trading stop loss, moving stop loss level based on mechanical indicators. Okay. So let me go through a couple of examples of what these trailing stop loss looks like. So here are a couple of examples of a trailing stop loss. On the first one, we have moving average, we have parabolic saw, we have ATR, we also have chandelier, and just simple support and resistance levels. So let's go through some examples. So here we have prices breaking out of that ascending okay, and it's also moving below our moving average. So we're going in for a sell entry here. And price is moving below our moving average, and but our trailing stop loss is triggered once price crosses above our moving average indicator. Okay, and that got us out before this happened. Okay, now on a on the same chart, but on by using a different technique. Here we are using the trendline trailing stop loss technique. Again, same chart, so prices are moving in a descending trend line. But the trailing stop loss is triggered when price crosses over descending trend line. Okay, again, same kind of the same idea, using a different indicator in this case. We have price moving below a parabolic saw. and then our trading stop loss is triggered when price crosses above the parabolic star indicator. Okay, and we have the chandelier and ATR trading stop loss. I think you guys can kind of get the idea now. Prices are moving below. Once they cross over, the stop loss is triggered and it gets us out before prices start heading back towards our entry. Okay, here's an example of prices breaking the ascending trend line and moving below the moving average. So we're moving so prices are moving below and our take profits are realized here before prices cross over and we get stopped out there. So this is just an example of how you can combine your moving average indicator along with your support and resistance levels. Okay. We mentioned a bit about hedging earlier, so I just wanted to quickly touch on hedging since we're talking a lot about risk management. So what exactly is it? It's a key risk management strategy that helps to offset potential losses by taking a counteracting position in the same or a correlated asset. Okay, so you can kind of think of it like an insurance for a trade. So you're protecting yourself from adverse market movements that could harm your primary position. Okay, so how does it work? When you enter a trade, a hedge, you're essentially balancing the risk of your initial position by opening an opposing trade. So this counter position can reduce or neutralize your losses if the market moves against your main trade. Okay, so the example I gave here is that if you're holding a long position in the euro dollar because you expect the euro to strengthen against the US dollar, but there's an upcoming economic event, perhaps a Federal Reserve announcement that could create volatility. So to hedge against this, you open a um you open a short position in euro dollar to balance out your initial position. So if the euro weakens and the euro dollar drops, then the loss in your long position will be offset by the gain in your short position. Okay, some reasons why you can hedge. Firstly is risk mitigation, capital preservation, profit consistency, and market neutrality. Some types of Forex hedging strategies. You have direct hedging, which basically involves opening and offsetting position in the same currency pair. The example is exactly the same as what we mentioned earlier. Cross hedging basically involves using correlated currency pairs to create a hedge. So here we are using, if you're going long on pound dollar, you might go short on the euro dollar or the dollar yen because they're historically correlated. Then we have the options-based hedging, which I think I mentioned earlier. So options give you the right to buy or sell at a predetermined price without the obligation to do so. So this flexibility helps you to manage risk while keeping costs low. We'll get a bit more in depth into what each of these entail in the following slides. And we have forwards and futures hedging, which we also mentioned earlier, which basically involves locking in a currency price for a specific date in the future, either through a forward contract or a futures contract. So it's commonly used by corporations to hedge against currency risk in international trade, but can also benefit individual traders. Okay, so direct hedging, this is quite straightforward. Some pros of this is that it's simple and effective, especially in highly volatile markets. Cons is that it can limit your profit potential since gains on one side offset losses on the other. And also transaction costs like spreads and swaps can add up quickly as well. Cross hedging, sorry about the font, but we've talked about this earlier. Some cons, or rather some pros, is that it's more cost effective. And it also provides some flexibility because you're not fully canceling out your exposure to the main currency. The primary risk here is correlation risk because while pairs may be generally correlated, they don't always move in perfect tandem. Okay, some examples here. You can make use of my FX book for correlation table. So we typically want to look for correlations that are greater than 80 and lower than negative 80. So you can put that into the filter. And this is what it'll do. It'll simply highlight all of the currency pairs that match up with what you've requested. So it's a really easy way of finding correlations. Okay. And lastly, options-based hedging. We kind of went through this a little bit, but it basically is a more sophisticated approach that offers flexibility and it allows you to manage risk without committing to a specific position. So benefits is that it's flexible, it's also cost effective because options generally have lower upfront costs compared to maintaining two active positions in direct hedging. Okay. Um, that's all for my slides, but before we go, I just wanted to quickly bring up VIX. Um, so this is the VIX chart. Just wanted to highlight how you can make use of the VIX spikes. So some most notable spikes, I think you can kind of already tell here. Okay, I guess we'll start off with the 2008 financial crisis. You can see here where I've placed it as 2008. Um, I think this is one of the highest spikes in the VIX on record. And it was reaching levels above 80. So this occurred due to the GFC, um, which was because of collapse of major financial institutions and a severe liquidity crunch, also widespread fear of economic collapse. Okay, so the market impact of this is that the S&P 500 declined sharply, and other major indices worldwide followed as well because investors would rush to sell equities and other riskier assets. So you can see how in this case, the VIX reflected extreme market fear. Yeah, with spikes in this index often preceding major drops in the market. Okay, the second spike here is the pandemic in March 2020. You can see that spike as well. You can see this is the highest point that it went. Okay. I think it goes without saying, but COVID-19 obviously impacted a lot of economies worldwide due to the lockdowns, unemployment surges, and disruptions to global supply chains. So again, the VIX spiked above 80 in March 2020, signaling severe uncertainty and fear. Okay, so as a result of this, the S&P 500 and other global markets dropped sharply, making one of the fastest declines and recoveries in market history. So this extreme VIX level was a clear reflection of panic selling as investors feared prolonged economic shutdowns. So actually a result of this was the transition to safe haven assets. So high VIX levels saw corresponding rise in the price of gold, um, government bonds as well, and other lower risk assets. So traders who shifted funds into safe haven assets managed to kind of mitigate some losses in the equity market. Okay, let's see what this recent spike is. Um, I'm actually not too sure. Yeah, I'm gonna have to check on that. But yeah, are there any questions? Okay, so to end off, I guess some key takeaways would be that um VIX's role as a reliable indicator of market sentiment during high stress events shows that it's really quite helpful. Um, However, firstly, spikes in VIX often align with sudden market sell-offs and hedging mechanisms, or to take advantage of volatility through VIX-related instruments. Secondly, mean reversion tendency. So the VIX tends to revert to its average, so extreme highs often lead to eventual decreases, which present opportunities for contrarian trading. And lastly, major geopolitical economic events often will cause temporary VIX surges, so it allows traders to benefit from short-term volatility without committing to longer-term positions. And yeah, that's pretty much it from me. Are there any questions? Okay. If there are no questions, that's all I have for you guys for today. Thank you guys so much for joining me. I hope you guys found this session helpful. Um, and yeah, I will see you guys again next week. Thanks, everyone. Bye.